Hello and welcome to Module 3 of Pepperstone's Intermediate Trading course, Chart Pattern Analysis. Double top and bottom patterns are amongst the most widely recognized chart patterns used by traders, but although popular, they are very rarely traded correctly. This section will show you how to correctly identify and trade these patterns to help you not only increase their success rate, but also to ensure you only choose quality patterns and in the right areas. In this lesson, you will learn how to identify double top formations, the best way to trade double top formations, how to identify a double bottom formation, and the best way to trade a double bottom formation. Double tops and bottoms are reversal patterns that appear quite regularly in all time frames and in all trading instruments, and will give you many opportunities to trade them when you know what you are looking for. Traders all too often make the same mistakes when trying to identify where a double top or bottom may be, and more importantly, make the same mistakes when attempting to trade them. The example on the screen illustrates the elements required for a double top to form. Firstly, price needs to be in an uptrend, ideally making smooth higher highs and higher lows. Once price is confirmed to be in an uptrend, you will then be on the lookout for a peak that is equal to or just a little higher or lower than the previous high, as we can see here. Price has now formed the two peaks required for a double top formation. The trough separating the two peaks is where the intersect line can be drawn, which is more commonly known as the neckline. In order to trade a double top pattern correctly, you have to wait for price to cross the neckline to the downside and close the period below it. If price fails to do this, then the double top pattern has not been validated and should not be traded as a double top setup. If price does close below the neckline, the double top has been validated and you can place your order. Although there are no hard and fast rules that apply as to how far each of the peaks should be apart, I have found that the most reliable double tops have a distance between the two peaks that is no greater than 1.5 times the height of the peaks to the neckline, as we can see here highlighted with the red arrows. Let's take a look at an example on a real chart with a typical double top. We can see that there is an uptrend in motion with a series of higher highs and higher lows. You can see that two peaks form at the top of the trend with close to equal highs. Once this happens, it is easy to identify where the neckline is, and that is where the double top can be validated. The blue square we see here highlights the candle that broke through the neckline and validates this double top by closing below. Many critics of technical analysis argue that double tops and bottoms are easy to identify in hindsight and are therefore difficult to trade. But if you follow the simple steps I have just explained, you can see that the only requirement to be able to trade a double top live is to be there when the neckline is broken by the candle or bar in the time frame that the double top appears. It is very important to wait for the confirmation break of the neckline, because if price fails to continue in its downward advance, the area may act as support and continue the uptrend that was already in place. Let's now look at a trading strategy that can be applied to trading a double top formation. Firstly, there needs to be an uptrend in place, which we can see here in the example, and then we need to be on the lookout for two peaks that are close to or equal to each other. Remember that the market isn't a perfect mechanism, so the prices aren't always going to be the same. We are now able to see the neckline, which is at the bottom of the two peaks. As the example shows, there is a very clear break zone to look out for to validate this double top. Once price goes through the neckline and closes below it, the double top formation has been confirmed and we can place a sell order. The expected move of the double top is generally worked out as being the distance from the neckline to the highest peak. In this example, the distance is marked with an A, and the profit target will be equal to this distance marked with a B. This calculation makes double tops very easy to trade, because there is little room for error when placing your profit target. The stop loss is just as easy to calculate, and is placed just above the highest peak. Let's now take a look at a double top in action to see how it would appear in a real market. Firstly, an uptrend needs to be in place, which we can see here on the example, and then we need to be on the lookout for two peaks that are close to or equal to each other. We are now able to see the neckline which is at the bottom of the two peaks, and the break zone is very clear, and we can see the candle that has broken through and closed below the neckline marked in the blue box. Once the candle has closed, the double top pattern has been validated, and you can trade short on the open of the next candle, marked with the red arrow. The distance can now be measured from the neckline to the top of the peaks, and this will give you the take profit target. As an example, if the distance from the neckline to the peak equals 60 pips, you place your take profit target 60 pips lower than the entry. The stop loss is placed just above the highest peak in the pattern, and then you let the market do its thing. It is important to remember that the break of the candle or bar must happen on the time frame that the double top is most clear. As an example, if the double top appears on a 4-hour chart, it must be a 4-hour candle or bar that closes below the neckline in order for the pattern to be validated. Let's now take a look at double bottom chart patterns. The example on the screen illustrates the elements required for a double bottom to form. Firstly, price needs to be in a downtrend, ideally making smooth lower highs and lower lows. Once price is in a confirmed downtrend, we need to be on the lookout for a trough that is equal to or just a little lower or higher than the previous trough. Price has now formed the two troughs required for a double bottom formation, and the peak that separates the two troughs is where we can draw the neckline. In order to trade the double bottom pattern correctly, you have to wait for price to cross the neckline to the upside and close the period above it. If price fails to do this, then the double bottom pattern has not been validated and should not be traded as a double bottom setup. If price does close above the neckline, then the double bottom pattern has been validated and you can place a long order. As with double tops, although there are no set rules that apply to how far each of the troughs should be apart, I like to apply the same measurement technique used with the double top pattern, where the distance between the troughs should be no greater than 1.5 times the height of the troughs to the neckline, as we can see here marked with the red arrow. The example we see on the screen now displays a real chart with a typical double bottom, and there is a clear downtrend in motion, with a series of lower highs and lower lows. You can see the two troughs that form at the bottom of the trend, with close to equal lows. Once this happens, it is easy to identify where the neckline is, and that is where the double bottom can be validated. The blue square we can see on the screen highlights the candle that broke through the neckline and validated the double bottom by closing above. It is important to remember that the double top and double bottom patterns are reversal chart patterns, and that is why you need validation before you trade them. Trying to predict when a trend is going to end can be a very dangerous way of trading, and by not waiting for validation, the momentum of the market can easily return to the original direction and take out stop losses quite quickly. Many traders attempt to forecast a double top or bottom pattern before any validation is visible, and it is this practice that reduces this chart pattern's otherwise solid success ratio. Now let's take a look at a trading strategy that can be applied to trade a double bottom formation. Firstly, you look for a downtrend, which we can see in the example on the screen, and then we look out for two troughs that are close to or equal to each other. Again, you must remember that the market isn't always exact, so the prices aren't always going to be the same. We are now able to see the neckline, which will be at the top of the two troughs, and as the example shows, there is a very clear break zone to look out for to validate this double bottom. Once price goes through the neckline and closes above it, the double bottom pattern has been confirmed, and we can place an order to go long. As with the double top pattern, the expected move of the double bottom pattern is worked out as being the distance from the neckline to the lowest trough. In the example we see on the screen, this distance is marked with an A, and the profit target will be equal to this distance marked with a B. Again, the stop loss is just as easy to calculate, and is placed just below the lowest trough. Let's now take a look at a double bottom in action, to see how it would appear on a real chart. Firstly, a downtrend needs to be in place, which we can see here on the example, and then we need to look out for the two troughs that are close to or equal to each other. We are now able to see the neckline, which will be at the top of the two troughs. The break zone is now very clear, and we can see the candle that has broken through and closed above the neckline marked in the blue box. Once we have this confirmation, the double bottom pattern has been validated, and we can trade long on the open of the next candle or bar, marked here with the red arrow. The distance from the neckline to the bottom of the troughs can now be measured, and this will give us our take profit target, with the stop loss placed just below the lowest trough in the pattern. Double top and bottom chart patterns are not only easy to identify, but they are also very easy to trade when you follow the rules that I have outlined. If you have to really think about whether it is a double top or a double bottom pattern, then it probably isn't a high quality one anyway, and it may be best to let it go and look for the next best trading opportunity. In this lesson, we have learned how to identify a double top formation. We have learnt the best way to trade a double top formation when it has been validated. We have learned how to identify a double bottom formation, and we have learnt the best way to trade a double bottom formation when it has been validated. This concludes section 1 of chart pattern analysis. In the next section, we are going to have a look at head and shoulders and inverse head and shoulders patterns. These reversal patterns provide very important information about what price action is showing, and this section will show you how to trade these powerful patterns correctly. Hello and welcome to Module 3 of Pepperstone's Intermediate Trading course, Chart Pattern Analysis. I'm sure there aren't too many traders out there who have not heard of a head and shoulders chart pattern, and there are probably many who have had a go at trading them. This section will explain why head and shoulders patterns form in relation to market action, and more importantly, how to identify and trade them correctly. In this lesson, you will learn how to identify a head and shoulders formation, the best way to trade a head and shoulders formation, how to identify an inverse head and shoulders, and the best way to trade an inverse head and shoulders. Like a double top pattern, a head and shoulders pattern is a bearish reversal pattern that often signals the top of an uptrend. The image that we can see on the screen displays an uptrend, with a series of higher highs and higher lows. Once price reaches a new high, it pulls back further than the previous pullback length to around the same as the previous trough. Price then attempts to push higher after finding some support in this area, but fails to reach the high of the previous peak, and subsequently returns to the same support level. As the example on the screen illustrates, the first peak makes up the left shoulder, the higher peak in the center makes up the head, and the last peak, which failed to make a new high, makes up the right shoulder. As with double top patterns, the line that intersects the troughs is called the neckline, and you can now see where this pattern gets its name. When price moves down further through the neckline and closes below it, the head and shoulders formation is complete and can now be traded. Identifying quality head and shoulders patterns can be quite subjective, so in order to identify only quality patterns, you can apply a simple rule similar to that of the double top pattern. The height of the left hand and the right hand peaks should not be greater than 2/3 of the height of the head. Also, the distance between the troughs of the left hand and right hand shoulders should not be greater than the distance between the troughs that make up the head, as you can see highlighted by the red arrows. The head and shoulders pattern that we have just seen is a conventional perfect formation pattern, but there are other versions of head and shoulders patterns that can be just as powerful. The first example that we can see here on the left is a head and shoulders that is slanting up. You can see that the right hand shoulder has a peak reasonably higher than the left hand shoulder, but still lower than the head. This type of head and shoulders formation indicates that there is more strength in the uptrend than the standard formation, because the pullback level on the middle peak, the head, didn't come back to the same level as the trough on the left hand shoulder. Also, the power of the market pushed the right hand shoulder higher than the left hand shoulder, again displaying more upward strength. The second imperfect formation we can see on the right is a downsloping formation, and these are sometimes considered stronger than the standard formation. In this pattern, the head has retreated further than the trough on the left hand shoulder, and the peak on the right hand shoulder has failed to reach the height of the left hand shoulder. This displays more weakness in the uptrend, as the market momentum is failing to advance to the same levels as the previous peaks. Now let's take a look at what a head and shoulders pattern looks like in a real market. The price is in a clear uptrend with a series of higher highs and higher lows, and you can see the formation of the first peak, which then goes up to make a higher high, retreating again to the same level as the previous trough. Price again rallies and makes a new peak at around the same level as the left shoulder, before retreating again down below the neckline. Now once price crossed the neckline and closes below it, the formation is complete, and you are able to take a trade short from this point. It is important to remember that the close of the candle or bar below the neckline needs to complete on the time frame that the head and shoulders pattern appears most clear. The example that we can see here on the screen will show us how to trade a head and shoulders pattern once it has been identified. The head and shoulders pattern is evident with the left and right shoulders on either side of the head in the middle. We can now draw the neckline under the troughs of the three peaks to provide the zone that needs to be broken to confirm this formation. Once price has moved and closed below the neckline, you have the confirmation needed, and a sell order can be placed from this level. The height from the neckline to the top of the head peak is then measured to provide the distance for the take profit target, as we can see here. The stop loss is placed just behind the right shoulder of the pattern to give the market room to move. The great thing about head and shoulders patterns is that the head will always be higher than the shoulders, so the profit target will always be greater than the initial stop loss, which sits just above the right shoulder. Let's take a look at what a head and shoulders pattern looks like on a real chart. You can see that there is an uptrend in place, with the left shoulder clearly visible. Price then moved higher and retreated to the trough of the first shoulder before rallying again to make the right shoulder. Now the neckline is very clear, and when price retreats and closes below the neckline, as we can see in the blue box, you have a signal to go short. The distance is measured from the top of the head to the neckline to provide the take profit target, and the stop loss is placed just above the right shoulder to finalize the setup process. As I mentioned earlier, head and shoulders formations are reversal chart patterns, and quite often move considerably more than the profit target that is being set by the head and shoulders neckline measurement. Now, although this is the case, many head and shoulders just pause an uptrend rather than reverse it, but the pause often provides the movement required to make the trade successful. This allows you to trade far more successfully using this pattern, rather than just waiting for the big reversal and seeking more profit, which happens less often. As you have probably guessed, the opposite of a head and shoulders pattern is an inverse head and shoulders pattern. And like a double bottom pattern, an inverse head and shoulders formation is a bullish reversal pattern, often signaling a bottom of a downtrend. The example on the screen shows a downtrend in place, with a series of lower highs and lower lows. You can see that after price reaches a new low, it pulls back further than the previous pullback length, to around the same level as the previous peak. Price then attempts to push lower, after finding some resistance in this area, but fails to reach the low of the previous trough. It subsequently returns to the same resistance level. As the example demonstrates, the first trough makes up the left shoulder, the lower trough in the center makes up the head, and the last trough, which failed to make a new low, makes up the right shoulder. As with double bottom patterns, the line that intersects the peaks is called the neckline, and again, you can see what appears to be an upside down head and shoulders shadow. When price moves up through the neckline and closes above it, the inverse head and shoulders formation is complete and can be traded long. Identifying quality inverse head and shoulders patterns can be quite subjective, so in order to identify only quality patterns, we can apply a similar rule to that of the double bottom pattern. The height of the left hand and right hand troughs should not be greater than 2/3 of the height of the head, and the distance between the peaks on the left and right hand shoulders should not be greater than the distance between the peaks that make up the head, as you can see highlighted with the red arrows. The inverse head and shoulders pattern that we have just seen is a perfect formation pattern. But like the head and shoulders, there are other versions of inverse head and shoulders patterns that can be just as powerful. The example on the left is an inverse head and shoulders that is slanting down, and you can see that the right shoulder has a trough reasonably lower than the left shoulder. This type of inverse head and shoulders formation indicates that there is more strength in the downtrend than a standard formation, because the pullback level on the middle trough, the head, didn't come back to the same height as the peak on the left shoulder. Also, the power of the market pushed the right shoulder lower than the left-hand shoulder, again displaying more downward strength. The second imperfect formation on the right is an upsloping pattern, and these are sometimes considered stronger than the standard formation. In this pattern, the head has retraced further than the peak on the left-hand shoulder, and the peak on the right shoulder extended higher than the peak on the left shoulder. This displays more weakness in the downtrend, as the market momentum is failing to push the price to new lows. The example that we can see on the screen demonstrates what an inverse head and shoulders looks like in a real market. We can see that price is in a clear downtrend, with a series of lower highs and lower lows, and we can see the formation that makes the first trough, which then goes on to make a lower low, retracing again to the same level as the previous peak. Price again pushes lower, and makes a new trough at around the same level as the left shoulder, before retracing up above the neckline. Once price has crossed the neckline and closes above it, the formation is complete, and you are able to trade the market long. Again, it is important to remember that the close of the candle or bar above the neckline must happen in the time frame that the inverse head and shoulders pattern looks the most clear. Let's now have a look at an inverse head and shoulders trading strategy. The inverse head and shoulders pattern that we can see on the screen is evident, with the left and right shoulders on either side of the head in the middle. The neckline can be drawn over the peaks of the three troughs to provide the zone that needs to be broken in order to confirm the pattern. Once price has moved and closed above the neckline, you have the confirmation required and can place a buy order to go long from this level. The height from the neckline to the top of the head trough is then measured to provide the distance for the take profit target, with the stop loss placed just below the right shoulder of the pattern to give the market room to move. The example that we can see on the screen illustrates what an inverse head and shoulders pattern looks like in a real market. There is an established downtrend in place, and the left shoulder is clearly visible. Price then moved lower and retraced to the peak of the first shoulder, before falling again to make the right shoulder. The neckline is now very clear, and when price retraces and closes above the neckline as highlighted in the blue box, you have a signal to take a long position. The distance is measured from the top of the head to the neckline to provide the take profit target, and the stop loss is again placed just below the right shoulder to finalize the trade process. In this lesson, we have learned how to identify head and shoulders formations. We have learnt the best ways to trade head and shoulders formations once they have been identified. We have learned how to identify an inverse head and shoulders pattern. And finally, we learnt the best way to trade an inverse head and shoulders pattern once it has been identified. This concludes section 2 of chart pattern analysis. In the next section, we will learn about the triangle family of patterns and explain the differences between symmetrical, ascending and descending triangles, and which trading environments they work best in. Hello and welcome to Module 3 of Pepperstone's Intermediate Trading course, Chart Pattern Analysis. This section will focus on the triangle family of patterns made up of the symmetrical, ascending and descending triangles. We will look at how to correctly identify triangle patterns and how to trade them using the most effective stop loss and take profit levels. In this lesson, you will learn how to identify and trade symmetrical triangle patterns long, how to identify and trade symmetrical triangle patterns short, how to identify and trade ascending triangle patterns, and how to identify and trade descending triangle patterns. Let's first take a look at symmetrical triangles. As the name suggests, a symmetrical triangle pattern has two close to equal sloping sides coming to a point on the right-hand side, as we can see in the example on the screen. A symmetrical triangle represents price action that is consolidating, with the range becoming tighter as it moves through the triangle. Now, symmetrical triangles can occur in many places throughout a trend, but generally appear when a trend is taking a pause, or closer to the end of an up or down trend, and they are generally seen as a continuation pattern. There is no bias for which way a symmetrical triangle could break, as they can go long or short depending on the market conditions. To draw the triangle, you need to be on the lookout for a consolidating price action, where you can draw close to symmetrical lines sloping in a triangle shape after a few touches on each side. These lines are then projected forward until they intersect, forming what looks like a triangle. The example that we can see on the screen is a symmetrical triangle which has broken to the upside. After consolidating inside the two sloping lines, price has broken through the top line and continued an upward move. Let's now take a look at a trading strategy where we can trade a symmetrical triangle long. The example that we see on the screen explains a trading strategy that can be applied to a symmetrical triangle pattern breaking the upper boundary. As we can see, price is bouncing from one end of the triangle to the other, finding resistance and support on each triangle line. When a symmetrical triangle pattern is identified, you will be on the lookout for a breakout on either side, and generally, the breakout will happen 2/3 of the way through the triangle pattern. A good rule of thumb is to apply a scale similar to the one that we see on the screen to help identify where the break may occur. Remember that the closer the break is to the ideal breakout location, the stronger the expected move will be. The second part of the strategy is to confirm the breakout. Similar to other patterns discussed earlier, a confirmation breakout is valid when the candle or bar on the chart the pattern appears on closes outside the boundaries. The third part of the trading strategy involves setting up the stop loss and take profit targets. As we have seen in earlier pattern examples, the stop loss and take profit levels are predetermined by the size of the pattern. In the case of the symmetrical triangle, once there is a confirmed break, you can measure the base of where the triangle started and project the take profit the same distance. The stop loss is placed just below the last swing where price intersected the bottom of the triangle, as we can see here. The example we see on the screen now demonstrates how to trade a symmetrical triangle long in a real market. We can see the two symmetrical lines that make up the triangle, with price slowly contracting as it moves through. Price then breaks out the top line of the triangle and closes above, providing the confirmation that is required. You can now measure the base from where the triangle started and project that distance out to give the profit target, with the stop loss placed just below the bottom triangle line. Due to the nature of how profit targets and stop losses are set, symmetrical triangles offer good risk-reward ratios, as the stop loss is never far away from the entry point. Now let's take a look at how to trade symmetrical triangles breaking short. The example that we can see on the screen is a symmetrical triangle breaking to the downside. You can see that we apply the same process to project the take profit target and where the stop loss needs to be for this particular trade. Let's now take a look at a symmetrical triangle breaking out short and see how it would be traded. Price first consolidates inside the sloping triangle lines and finally breaks through around 2/3 of the way through the pattern, as you can see highlighted in the blue box. We can then measure the base of the triangle where the pattern started to project the take profit target and place the stop loss just above the downward sloping line. The next member of the triangle family are ascending triangles. As we can see in the example on the screen, ascending triangles have a horizontal line at the top of the pattern, and the bottom line of the triangle slopes in an upward direction. We can draw this triangle by finding an area on the chart with overhead resistance, where price is slowly making equal highs and higher lows, and drawing a horizontal line. We can then draw a line joining the rising troughs until the two lines intersect, forming the ascending triangle. Unlike symmetrical triangles, and as the name suggests, we are only looking for a break to the upside on ascending triangles. Let's now take a look at the trading rules for ascending triangles, as they do differ a little bit from the symmetrical triangle rules. Firstly, we are looking for a break to the upper boundary of the triangle, again ideally breaking around 2/3 of the way through the pattern. Once there is a close of a candle or bar above the top line of the triangle, the pattern is then confirmed. The take profit target is projected a little bit differently to symmetrical triangle patterns. The distance is measured 2/3 of the maximum height of the triangle, and this same distance is used to project the take profit area, as you can see in the example on the screen. The stop loss is worked out the same way as a symmetrical triangle pattern, placed just below the ascending line or the highest trough. Now let's take a look at how we would trade an ascending triangle in a real market. As we can see on the example on the screen, the pattern is confirmed by the candle break in the blue box. The stop loss can be placed just below the sloping horizontal line, and 2/3 of the maximum height of the triangle is measured to project the take profit target. The final member of the triangle family are descending triangles, and as the name suggests, they are the opposite of ascending triangles, and can generally be found at the tops of uptrends. When searching for descending triangles, you need to be on the lookout for a series of troughs that are forming at around the same price level, with the peaks between these troughs getting lower, as we can see on the screen. Descending triangles can also form during a downtrend, and can be found at areas with minimal support, where overhead pressure is forcing price down as it makes lower peaks. Let's now take a look at a descending triangle trading strategy. For a descending triangle to be validated, we must wait for a confirmation close of a candle or bar below the bottom boundary of the time frame that the descending triangle appears on. The projection of the take profit is worked out in the same manner as the ascending triangle, where the distance 2/3 of the maximum height of the triangle is measured. This distance is then used to project the take profit level, as we can see on the screen. The stop loss is also worked out the same way as previous triangles, placed just above the descending line or the lowest peak. Let's now take a look at a descending triangle in a real market to see how we would go about trading it. We can see in the example that there is a series of troughs that are around the same level, so a support line can be drawn which forms the bottom of the descending triangle. As we can see in the example, as price continues down its path, each of the peaks are getting lower, and once there are two in sequence, a sloping line can be drawn and projected through until it intersects with the support line. The blue box indicates where the candle broke through and closed below the support line, which provides a signal to enter a short position for this descending triangle. As you can see, the break happened at an optimal time in the triangle development, around 2/3 of the way through the pattern. Now that the triangle is drawn, you can go ahead and measure 2/3 of the maximum height to provide the projected take profit level, and the stop loss can be placed just above the last peak before the break of the bottom of the triangle took place. This pattern provides a good risk-reward ratio, as the take profit level is twice as large as the distance required for the stop loss. When searching for any triangle patterns in your analysis, it is always best to find the most filled patterns. By that, I mean that generally the best and most successful triangle patterns, whether they are symmetrical, ascending or descending, have price filling the space of the triangle evenly. I generally have a white background on the charts that I use, as this is my preference. So in these types of patterns, I like to see very little white space inside the pattern itself. The pattern that we can see on the screen is a good example of the price filling out this descending triangle quite nicely. The reason for this is because when price is touching the upper and lower boundaries of the triangle formations, each touch represents price respecting the support and resistance, which is essentially all a triangle formation is. It makes sense that the more a region is respected, in this case the upper sloping boundary that forms the top of the triangle, the more likely that the sellers will win the battle to restrict price from going any higher. On the bottom of the triangle, the more that the support line holds price as it continually bounces down and rejects off it, the more significant the break will be when price eventually breaks through and closes below the bottom of the triangle or support line. In this lesson, we have learned how to identify and trade symmetrical triangle patterns in a long direction, how to identify and trade symmetrical triangles in a short direction, how to identify and trade ascending triangle patterns, and finally, how to identify and trade descending triangle patterns. This concludes section 3 of chart pattern analysis. In the next section, we will take a look at flags and pennants, a personal favourite of mine due to their high success rate and great risk-reward ratios. We will examine how to find the best quality patterns and how to use the most appropriate take profit and stop loss zones. Hello and welcome to Module 3 of Pepperstone's Intermediate Trading course, Chart Pattern Analysis. Flag and pennant patterns are a personal favourite of mine for a very good reason, as they have a great success rate. Flags and pennants are continuation patterns, and the key to taking advantage of these great patterns is to identify when they are in the correct zone in relation to what the market is doing. This section will explain how to correctly identify these popular chart patterns and how to trade them using the most effective stop loss and take profit levels. In this lesson, you will learn how to identify flag patterns in uptrends and downtrends, how to trade flag patterns in the real market, how to identify pennant patterns in uptrends and downtrends, and how to trade pennants in the real market. All too often, traders locate what they think is a good flag pattern, but they find that they don't move as expected. This is generally because although the flag formation may have appeared, it was just not in the correct area. The example that we can see on the left describes a flag pattern in an uptrend, with the flag component sitting above what looks like a flagpole. This is generally associated with a strong move up in the space of 1 or 2 candles, followed by price then consolidating inside the flag, making a series of lower peaks and lower troughs. After a period of consolidation where the flag shape forms, price breaks through the top of the flag and continues the powerful move up that preceded the consolidation period. The key to confirming that the flag you are looking at is a quality pattern is ensuring that the initial move, the flagpole, breaks out of a consolidation period of its own, similar to the example on the screen. This confirms that after a period of uncertainty, the buyers have taken control and pushed the market forward with a great deal of force. There is a very logical reason why the flag forms after the initial aggressive move. The area of consolidation is made up of buyers who captured the initial move taking their profits or locking some of the profit in, and selling to the new buyers who missed the initial move and want to take part in what they think is the next rally. Once the balance of the buyers and sellers equals out, the next aggressive move often begins, making the flag continuation a self-fulfilling prophecy. You can see in the example that the price breaks out of an area of consolidation and forms what looks like a flagpole. It then consolidates through the flag area before breaking out into the next move up. A flag pattern in a downtrend works in a similar fashion, but you have to imagine that the flagpole and the flag are both upside down. The same process happens initially, with price breaking down from an area of consolidation, and forms the leg of the pole. Price then begins to consolidate in a similar way to the flag uptrend, only this time it is making higher peaks and higher troughs inside the flag. When the balance of buying and selling is complete, price continues on its downward advance, breaking through the bottom of the flag and moving on to make new lows. Let's now look at the best way to trade a flag pattern once a quality formation has been identified. In the example that we can see on the left, there is a flag pattern in an uptrend. The consolidation area is in the middle, which is followed by an aggressive break to the upside. Once the flag starts to form, you need to be on the lookout for a break above the top of the flag. As with all of the patterns that we have discussed, the break is not confirmed until there is a close of a candle or bar on the time frame that the pattern appears most clearly. Once the break is confirmed, a long position can be placed out of the flag. Two other great things about flag patterns, and why they are a favourite of mine, is their great risk-reward ratio, and that the take profit and stop loss levels are very easily identifiable. To work out the take profit, the distance is measured between the top of the consolidation area where the pole first broke out from, to the top of the flagpole before the consolidation started. The expected profit for this pattern will be the same distance projected out from the top of the flag where the break occurs. The stop loss is placed just below the bottom of the flag to give the market room to move. We can see on the right an example of a flag in a downtrend, and aside from how it looks, the way this pattern is traded is identical to the flag in an uptrend. The distance is measured from where the pole broke out in the consolidation zone down to the bottom of the pole, and the distance is projected from the initial break of the bottom of the flag. Again, the stop loss is placed just above the top of the flag, as we can see here in the example. Now let's take a look at a flag pattern in a real market uptrend. The consolidation area is clear prior to the sharp breakout, and the candles begin to consolidate through the flag, which now gives you the ability to locate where the downsloping flag lines can be drawn. Once there are 2 or 3 touches on either side of the flag, the lines can be projected forward, and you can wait for the break to the upside. The candle that broke out and closed outside the top of the flag is marked here in the blue box, and now the distance can be measured between the consolidation area and the top of the pole. That same distance is projected out at the area where price broke out, which provides the expected take profit level, and the stop loss is placed just below the bottom of the flag. Let's now take a look at what a flag pattern looks like in a downtrend in a real market. We can see the consolidation area is clear prior to the sharp breakout, and the candles begin to consolidate through the flag. Once there are 2 or 3 touches on either side of the flag, the lines can be projected forward, and you just wait for the break to the downside. The candle that broke out and closed outside the bottom of the flag is marked in the blue box, and now the distance can be measured between the consolidation area and the bottom of the pole. This same distance is projected out at the area where price broke out, which provides the expected take profit level, and the stop loss is placed just above the top of the flag. Now let's take a look at pennant patterns. Pennant formations are similar to flags, except that the sloping lines intersect as the price range narrows through the consolidation period. The example we see here on the left is a pennant in an uptrend, sitting above what looks like a pole. This is generally associated with a strong move up in the space of 1 or 2 candles. Price then consolidates inside the pennant, making a series of lower peaks and higher troughs, with the range getting tighter and tighter as it approaches the apex of the pennant. After a period of consolidation, where the pennant shape forms, price breaks through the top of the pennant and continues the powerful move up that preceded the consolidation period. Once again, the key to confirming the pennant you are looking at is a quality pattern is ensuring that the initial move, the pole, breaks out of a consolidation period of its own. This price action confirms that after a period of uncertainty, the buyers have taken control and pushed the market forward with a great deal of force. Pennants also form for the same logical reason after the initial aggressive move. The area of consolidation is made up of buyers who captured the initial move taking their profits or locking some of it in, and selling to new buyers who missed the initial move and want to take part in what they think is the next rally. Once the balance of buyers and sellers equals out, the next aggressive move often begins, making the pennant continuation again a self-fulfilling prophecy. As we can see in the example, the price breaks out of an area of consolidation and forms what looks like a pole. It then consolidates through the pennant before breaking out into the next move up. Pennant patterns in a downtrend work in a similar fashion, but you have to imagine that the pole and the pennant are upside down. The same process happens initially, with price breaking down from an area of consolidation and forms the leg of the pole. Price then begins to consolidate in a similar way to the pennant in an uptrend, again making lower peaks and higher troughs inside the pennant. When the balance of buying and selling is complete, price continues on its downward advance by breaking through the bottom of the pennant and moving on to make new lows. Now let's look at the best way to trade a pennant pattern once a quality formation has been identified. In the example we see here on the left, there is a pennant pattern in an uptrend. The consolidation period is in the middle, which is followed by an aggressive break to the upside. Once the pennant starts to form, you need to be on the lookout for a break above the top of the pennant. As with all patterns that we have discussed, the break is not confirmed until there is a close of a candle or bar on the time frame that the pattern appears most clearly. Once the break is confirmed, a long position can be placed out of the pennant. Like flag patterns, pennants provide you with a great risk-reward ratio, and the take profit and stop loss levels are very easily identifiable. To work out the take profit, the distance is measured between the top of the consolidation area where the pole first broke out from to the top of the pole before the pennant consolidation started. The expected profit for this pattern will be the same distance projected out from the top of the pennant where the breakout occurred. The stop loss is placed just below the bottom of the pennant, giving the market enough room to move. The example that we can see on the right is a pennant in a downtrend, and aside from how it looks, the way this pattern is traded is identical to a pennant in an uptrend. The distance is measured from where the pole broke out of the consolidation zone down to the bottom of the pole, and the distance is projected from the initial break of the bottom of the pennant. Again, the stop loss is placed just above the top of the pennant, as we can see here in the example. Let's now take a look at what a pennant looks like in a real market uptrend. The consolidation area is clear prior to the sharp breakout, and the candles begin to consolidate through the pennant, which now gives you the ability to locate where the sloping pennant lines can be drawn. Once there are 2 or 3 touches on either side of the pennant, the lines can be projected forward until they intersect, and you just wait for the break to the upside. The candle that broke out and closed outside the top of the pennant is marked in the blue box, and now the distance can be measured from the consolidation area to the top of the pole. The same distance is projected out at the area where price broke out, which provides the expected take profit level, and the stop loss is placed just below the bottom of the pennant. Now let's take a look at what a pennant pattern looks like in a real market downtrend. We can see the consolidation area is clear prior to the sharp breakout, and the candles begin to consolidate through the pennant, which now gives us the ability to locate where the sloping pennant lines can be drawn. Once there are 2 or more touches on either side of the pennant, the lines can be projected forward until they intersect, and we just wait for the break to the downside. The candle that broke out and closed outside the bottom of the pennant is marked in the blue box, and now the distance can be measured between the consolidation area and the bottom of the pole. The same distance is projected out at the area where price broke out, which provides the expected take profit level, and the stop loss can be placed just above the top of the pennant. As with the triangle patterns we discussed earlier, the quality of the flags and pennants can be measured by the amount of price that fills the pattern. Remember that the more the price touches the key zones, which reduces the white space, the better the pattern should be. In this lesson, we have learned how to identify flag patterns in uptrends and downtrends. We have learned how to trade flag patterns in real markets. We have learned how to identify pennant patterns in uptrends and downtrends. And finally, we learned how to trade pennants in real markets. This concludes section 4 of chart pattern analysis. In the next module, we will learn all about the indicators that I have found work best with the trading styles that we have discussed in this course. We will focus on some of the most powerful indicators available, including moving averages, the moving average convergence divergence, stochastics, RSI, and Bollinger Bands. We will focus on how to choose the correct indicator for the market or pattern that you are trading, which will help increase your consistency when choosing the right trades to place.